All right, so this is a journal entry for a transaction, a sales transaction. And I have to say, as an accounting professor, this is a type of journal entry that you are going to see on any introductory accounting class, exam, to just see if you know what is actually going on with different accounts when you sell something. What gets credited, what gets debited, and what accounts is it impacting? So this is a really good question to examine this. So on January 25th, we sold 500 baking mats at $10 each and 150 mini ovens at $120 each. The baking mat inventory cost $4 each, and the mini oven inventory cost $80 each. Now, what you're going to be tempted to do, so let's underline the key points here, right? So you sold 500 baking mats at $10 each and 150 mini ovens at $120 each. And the inventory, the mat inventory cost $4, mat inventory, and then the oven inventory cost $80, all right? Now what you're going to be tempted to do is to start throwing numbers together and netting them together. And that's not what we want to do when our core business is selling, in this case, baking. It looks like baking toys or baking goods. There's baking mats and the mini ovens. These are the things that we sell. This is our core business. And so we want to provide the details of the revenues and expenses. Don't be netting things in and out and trying to get to other things. We want to write down all the revenues and all the expenses separately in journal entries, all right? And so here we have baking mats being sold at $10 each and mini ovens at $120 each. Now it doesn't say whether it's on account or on cash. I'm just going to assume it's cash. So when we sell things, we get cash. So I'm going to have a debit here of cash, all right? The debit of cash. I know I'm getting cash. I know that's something that's happening. I know it's going to be an increase in cash. What do I also know? I know I'm also losing something. Once you sell that inventory, you don't get that back. You can't go back and say, hey, I sold you that inventory. Can I have it back? No. That's it. Somebody tells you, you try to go do that, they're going to tell you to pound sand. And so there's going to be a second entry here, and it's going to be a credit, and it's going to be a credit of your inventory, all right? So it's going to be inventory. All right, so your inventory is going to be credited, and the reason why it's going to be credited, I should probably put it a little bit over so it's clear that it's getting credited. I like to put the C next to it, but so it's a credit, but just to be clear, I'll put inventory right here to be credited, all right? So that inventory is going to get credited. Now, with each one of these, we started with the things we can touch. The cash is increasing. We're getting cash, all right? And the inventory is decreasing. We know we're losing inventory, all right? So let's stick with cash, all right? Well, what's the corresponding entry with getting cash? Well, us getting cash, we have a debit here of cash. And don't think that just because there's a debit and a credit that we're done. These are two different things. This is the inventory that's leaving that we have to account for. And this is the cash that we're receiving that we have to account. So this cash is going to be related to revenue or sales. You could call it either one. I'm going to just call it, why not just call it both? It's going to be related to a credit of sales, right? So this is going to be a credit to sales revenue. And I would call it sales, I would call it revenue, I could call it sales revenue. Either way, we know what you're talking about here. So sales revenue, and then inventory is getting credited, and we have to have a matching debit for that. What's our matching debit going to be? Well, our debit is going to be this thing called cost of goods sold. Cost of goods sold. And that is an expense. It's something that hits our income statement. So you might put cost of inventory sold, cost of something else, but the standard term is cost of goods sold. That's what the standard term is. Well, now we just have to figure out what the amounts are. Well, we bought 500 baking mats at $10 each. Well, 500 times $10 is $5,000, all right? $5,000 right here, all right? And then there's 150 mini ovens at $120 each. Well, 150 mini ovens at $120 each works out to about $18,000. All right. So those two amounts, if you take them together, is 23. The two of those together is equal to 23,000. So 23,000. That is how much money that we received when we sold our baking mats and our mini ovens. Cash of 23,000 was given to us. And we call that cash, we want to have an economic representation of that cash of 23. You can hear my kids wrestling around upstairs. The coronavirus is going on right now, and they're just making loud noises. I am so sorry. So 23,000 of cash, and then sales revenue of 23,000 right here. So we're labeling the cash that we received here, cash, as part of sales revenue to track it, right? Revenue, all right? So the cash and then the sales revenue, all right? So everything's in balance, it's increased, and it's increased our assets, and it also shows an increase in owner's equity. All right, our inventory though, our inventory is going down. And so what is the amount of our inventory? So the amount our inventory cost can be calculated at with this $4. $4 for the mats. We sold 500 mats at $4 each. That is going to equal $2,000. All right, that's 4 mats, $4 mats, and we're going to have 500 of them, right? And then our mini oven inventory cost, let me just bring it over here. Our mini oven inventory, that cost $80 each, all right? And we sold 150 of those, right? And since we sold 150 of those at $80, if we do the math on that, it is $12,000, all right? $12,000. And so the combination of these two is the total inventory that we sold, which is $14,000. All right, that's the inventory that left. It's good credit to inventory here. This journal entry is crediting inventory right here. And our representation of those resources leaving is going to be in cost of goods sold for the equal amount, $14,000. All right, $14,000 right here. So inventory is going down by a credit, and then our cost of goods sold represents that cost of goods sold right here. And that's reducing value in our income statement. So the cost of goods sold entry ends up here. The sales revenue ends up here. And then the resources related to those two entries, inventory ends up here, impacting this account, and the cash ends up impacting assets by going up. So cash brings assets up, inventory leaving brings assets down, cost of goods sold represents that inventory leaving down the video. Remember, you might be tempted to net these and to try to net the $4 with the 10 and then the 120 with the 80 to get the net amount. But the problem is if you do that, you're doing it wrong. That's the big problem. But mainly it's because we don't have this detail of the sales revenue and cost of goods sold for our income statement if we net them. We net gains and losses. We don't net revenues. We don't net the revenues. With revenues, we want to have an income statement that has revenues and then expenses and then gets us to our income. And the reason why is we want to examine what's happening to the revenue, examine what's happening to expenses, and see what's going on related to the two of those and how they interact, because that's our core business. And so we won't net those two things together. Gains and losses are things that we would net because these are unusual items. These are things that sometimes happen that are not what our core business is. When it's our core business of selling inventory and collecting cash associated with what our core business is, that's what we'll always do.